Hello, listeners, from Roy Demarev in Sam, just back from Russia, as you might have known from my last week's broadcast, and at the end of a period when I pretty well ignored, in terms of this broadcast at least, what's going on in the financial markets, as I played around with my papers and broadcasts on greening the city of Ekaterinburg, and then moving to the production of a real book which incorporates the work we've done on the greening of Ekaterinburg city, but which goes a lot further than that. It's a book being published in Canada with my good friend and partner Alan Bonnen and another chap called Brennan Schmidt, and we cover a lot of things, including the safety of cities and the impact of cyber, the cyber city, if you like, how that can be used very positively to organize things. That will be coming off the press quite soon, so I hope I can give you a report when it's ready. Yes, I've kind of enjoyed not having to worry about the financial markets and possible advice or comments on it, but I can't get away from that indefinitely. And of course, during these last 5 or 6 weeks, we have seen massive falls and then gains and then more shaking around of stock markets, and we've seen the introduction of President Trump's tax cuts. Now, I mustn't make any political comment on President Trump, but I think I'm entitled to talk about the economics impact of a tax cut. You see, the basis of the hope behind the tax cut is that it will allow more spending, because you put more money in people's profits, and the more spending in company profits is meant to be investments, and that will take the economy forward. In fact, that doesn't happen. All the evidence for the history of corporate tax cuts is that it has virtually no impact on the investment rate at which corporations operate. So we can't expect too much there. Tax cuts are just a shot in the arm, which might and will indeed improve GDP briefly, but the long-term impact cannot be positive. So you have to bear that in mind as we now face a period where the stock market is extremely unstable, and for the last few weeks, bond yields have been going up. Now the question about the bond yields is, are they going to continue up? And that's difficult to answer, but I'm going to attempt to. You see, I don't think we're entering a period of serious inflation. It's because there's so much spare capacity in the USA, and indeed in Europe, but especially in the USA, that I can't see the sense in supposing that there'll be lots of inflation and therefore that has to be controlled by putting up the rates. If it were true, the higher rates will cause the economy to slow down anyway, but I think it's quite possible that the rates won't continue up. They've gone up, but may not continue up higher at all or not much higher. And what does that mean? It means that bonds become more interesting as an investment than stocks. And that's a situation we haven't seen actually in many years. I've been kind of saying that there'll come a point when yields have gone up enough to make bonds interesting again as a return. I think that point is probably about there now. It could be in a few weeks' time. But the real point about the bonds is that they are protecting you against the downside. And the downside with the stock market at the moment is very precipitous. So we have to really act carefully, and I would actually think there's a case for pulling out of stocks, but at least switching some of the balance towards bonds. In fact, my friends at Harry Dent have even come up with a particular bond, or rather an ETF based on bonds. It's called the Vanguard Extended Duration Treasury ETF. Okay, you may or may not want to pick that one up, but there are ETFs in bonds which are cleverly run. In fact, the people in Harry Dent suggest putting a stop loss, because it's quite an aggressive investment to do that. A stop loss on bonds is quite an original idea, isn't it? For me it is, anyway. Now, further analysis by Harry Dent and Company shows that the earnings per share have gone up quite a lot faster than earnings as such. And how could that happen? Well, regular listeners would have an idea, because I've mentioned this before. It's because of buybacks. If you buy back your own shares and you work out earnings per share, if you now have fewer shares outstanding, then the EPS goes up, even if overall earnings have not gone up. And that phenomenon explains why EPS has gone ahead and dragged the stock market prices with it way beyond real corporate earnings. Of course, we're still blaming QE, quantitative easing. That has brought about these very low interest rates, and that in turn has historically now, for some years, made bonds rather unattractive. And so investors, faute de mieux, have said, okay, well, we may as well buy shares because they could go up. They might not, but they could go up. But what they forget is they could go down as well. And we've been warning about the risk of it going down for so long now that I'm rather embarrassed that they haven't gone down. But I think they're going to do that in the fairly near future, in fact, in this very year. You may have noticed that the dollar is very weak against the euro and even against the pound, and the pound hasn't got a lot going for it at the moment. And that is hard to explain, because when yields on bonds go up, in principle, the money becomes, or the currency becomes more attractive. That hasn't happened. Perhaps that itself is a message to the effect that the market is not particularly happy about the Trump tax cuts. This won't be a long broadcast today, but let me come back to a fundamental issue, which is whether or not there is inflation, or inflation is about to take off, and therefore interest rates, yields on treasury bonds and corporate bonds, will they go on rising? And the counterintuitive idea which comes out of Harry Dent and Company is that the inflation is actually a myth. It's 1.5% and is unlikely to go up, and that therefore the interest rates on 10-year bonds, for example, is at or near a top. In fact, they think it might go up a little bit more, but not much more. So I think there is an opportunity now to go for those bonds in dollars, but you can also look over here and look at bonds in euros and even in Swiss francs, although the interest rate in Swiss francs is really rather hopeless. A general message in an economy like today's is that you should not be going hell for leather for any one type of investment. You really do have to diversify in currencies and in the mix of instruments that you go for. I have mentioned many times that I think ETFs are a good idea for, if you like, amateur investors, because we cannot spend the time and effort or have the tools that the professional investors have to pick shares or even pick bonds, although picking a bond is always a lot easier than picking a share. So I think ETFs, exchange-traded funds, is a rather convenient way for the masses, the hoi polloi, to make their investments. And I would just urge you to get well balanced as you look at your portfolio of ETFs. You need some which are dollar ETFs, some which are euro ETFs, and maybe other currencies altogether, although you need to understand what's going on in China and Japan, and if you don't understand, maybe forget it. And then I think a mixture of bonding ETFs with stock ETFs is a good idea to cope with this likely swing in the interest away from stock markets towards bond markets, which is really what we are saying this week. Speak to you again next week.